Welcome to TalkTickers, the show that dives deep into earnings calls so you don't have to.
And today we're looking at Dynex Capital. Their second quarter earnings just dropped.
Right, and it was quite a quarter in the markets, wasn't it? Felt like a real roller coaster sometimes.
Definitely. We saw some pretty wild swings, dislocations, stuff we haven't really seen since, early 2020.
Exactly. So the big question is, how did Dynex Capital manage through that? Management described their performance as, quote, attractive by any standard.
High praise. And we want to unpack that. How do they not just navigate, but actually, capitalize on that volatility?
We heard from the key management team, Byron Boston, Morathy Papano, Collagen, and TJ Connelly.
A solid lineup. And they were operating in, let's say, a dynamic environment.
That's one way to put it. So let's start with the results snapshot. How did they actually perform?
Pretty impressively, actually. Net interest income, for starters, kept climbing. That's always a good sign.
Mm-hmm. Shows the core business is generating value, even with market noise.
Right. And their market cap, that really tells a story.
It crossed $1.5 billion.
Yeah, as of June 30th. That's almost 50% growth since this time last year. Huge leap.
Wow. Was that just market appreciation?
Not entirely. They also successfully raised capital, $560 million during the year.
Okay.
And crucially, they did it at a premium to book value. That's smart, very accretive for shareholders. Shows confidence.
Definitely signals strong investor confidence. So where did that capital go? Into the portfolio.
You got it. The investment portfolio grew by 25% just since the end of Q1. Hit $14 billion.
25% in one quarter.
Yep. And it's over 50% larger than it was this time last year. They were deploying capital.
That's significant deployment in a volatile period. What about their safety net? Liquidity.
Strong. Ended the quarter with $891 million in liquidity. That's about 55% of their total equity. A solid cushion.
And the part many listeners focus on, dividends.
Good news there, too. They've increased the dividend, and it's now above pre-COVID levels. Shows commitment to shareholder returns.
Okay, so strong numbers across the board. Net interest income up, market cap soaring, successful capital raise, portfolio booming, solid liquidity, higher dividend.
Pretty much sums it up.
Which leads us back to the how. How do they pull this off, especially with April being so, chaotic? Mortgages, treasuries, swaps. It was messy.
It really was. And you're right, many would just try to ride it out. But Dynex, they seem to see it as an opportunity.
So it wasn't just luck, it was strategy.
Absolutely. They talked about proactive positioning, liquidity discipline, and sticking to their long-term view. They didn't just survive the dislocation. They actively used it.
They mentioned sticking to a core strategy. Can you break that down? What is it?
Well, in concept, it's quite simple. Raise capital, deploy it when assets look historically cheap and liquid, and then manage that portfolio really carefully through the ups and downs.
Simple concept, maybe harder execution and real-time volatility.
That's where the discipline comes in.
Yeah.
They saw value, grew the portfolio by over $3 billion in the quarter. That takes conviction and, frankly, good internal models and fast decisions.
And part of that deployment involved increasing leverage, right? From 7.4x up to 8.3x.
It did. That might sound aggressive to some, but they framed it as a return to normal.
A return to normal. How so?
They felt certain tail risk events were essentially off the table, things like worries about surprise government guarantee changes or certain legislative noise. Those faded.
Okay. So less systemic uncertainty allowed them to dial risk back up slightly.
Exactly. And this 8.3x level, they associate that with potential ROEs in the high teens to mid-20s range.
That's a significant return target.
It is. And they said they're willing to flex higher if the risk environment looks right. But the key enabler was funding.
The repo markets.
Yes. The mortgage repo market stayed very stable. Pricing, availability, both solid. Spreads to SOFR held consistently in that 15, 20 basis point range.
Okay, so cheap, reliable funding gave them the confidence to grow the asset side.
That's the foundation. You need that stable funding to make the strategy work.
Got it. So stable funding, clear strategy. Let's dig into the assets themselves. What are they buying?
Their main focus continues to be agency mortgage-backed securities, MBS.
Why agency MBS?
They see it as the best combination right now. You get liquidity, high credit quality, and importantly, strong return potential.
And what kind of returns are we talking?
On the new stuff they bought, fully hedged, they're seeing returns from the mid-teens up to the low 20% range.
Mid-teens to low 20s. Wow.
Yeah, they called it attractive by any standard. It's hard to argue with that.
Within those agency MBS, any particular flavor they prefer, like specific coupons?
They do. They have a bias towards lower coupons right now.
Why lower coupons?
The thinking is these will outperform if or maybe when mortgage rates eventually decline. It's a bit of a forward-looking bet within the MBS space.
Interesting. But it wasn't just agency MBS, right? They added some commercial MBS too, agency CMBS.
Correct. Opportunistically, they said. They added some agency CMBS, focusing on the 5-year part of that market.
Why 5-year agency CMBS? What's special there?
Stability. That's the key word. These instruments often have prepayment lockouts. So a 5-year bond might be locked out from prepayment for, say, 4.5 years.
Ah, so you get more predictable cash flow compared to regular mortgages where people can just refinance anytime.
Exactly. It diversifies and stabilizes the overall portfolio cash flow. And the returns look good, too, around swaps plus 90 basis points, especially when hedged appropriately.
They mentioned hedging with negative spread interest rate swaps. That sounds bad. Can you explain?
Yeah, it sounds counterintuitive. But negative spread just refers to the swap rate relative to treasuries in this context. The swap itself might technically cost a bit relative to a benchmark.
Okay.
But the overall trade of the high yields from the CMBS plus this specific hedge results in a really attractive, stable net return. The high asset yield more than compensates for the technical swap cost.
Got it. So the total package is profitable, even if one component has a negative label relative to something else.
Precisely. And it's not some obscure corner anymore. Big players like banks, insurance companies, they're in the agency CMBS market too.
Yeah.
It's mature, liquid.
Makes sense. Okay, shifting gears a bit. Beyond the portfolio, Dynex also talked about operational improvements, building their platform.
Yeah, and this isn't just about cutting costs. It's a long-term strategic play. They're bringing more functions in-house.
Like what?
Legal, IT, operations, accounting, key stuff. The idea is to build scale, yes, but also deeper institutional knowledge, make the organization more resilient, more agile.
Building an internal brain trust, essentially.
You could put it that way. And they're leaning into technology too. Mentioned internal developments and infrastructure, applications, even AI and machine learning. Staying cutting edge.
And they gave a shout out to some long-serving employees.
They did. Bob Nilsson, Wayne Brockwell, Allison Griffin, Mark Warner, Jeff Childress, all over 20 years. That says something about culture.
Definitely. And a new hire.
Yep, announced Michelot as the new chief legal officer and corporate secretary. Seems like a strong addition.
So strong quarter, clear strategy, building the operational backbone. What's the vibe looking forward? Management's outlook.
Confident. Very confident, I'd say. The focus remains squarely on long-term returns and dividends for shareholders. That's the core value proposition.
And they see more upside.
Clearly. They talked about meaningful value still to unlock through more growth, better stock liquidity, and just the general appeal of their platform ethically managed liquid investments.
And the current environment helps.
Absolutely. They noted the environment is highly favorable right now with agency MBS spreads still wide. Lets them keep harvesting those strong returns.
Okay, let's pivot to some investor context and Q&A points.
Yeah.
Back to leverage 8.3x. Did they give a specific target range?
Not a hard range, but they reiterated the return to normal idea linked to those tail risks fading. And they tied the current level to that high teens to mid-20s ROE potential.
And they're willing to go higher.
If the risk reward makes sense, yes, they emphasize flexibility. But in terms of raising capital right now, their focus is really on common equity, issuing stock, especially above book value if they can. The preferred markets, they said, have been kind of spotty. So common is the preferred route.
Makes sense. And speaking of book value, any updates since the quarter ended?
They gave one. As of the Friday before the call, so July 18th, book value is apparently almost unchanged from June 30th once you account for the accrued dividend. So pretty stable.
Good to know. Now, the broader mortgage market is key for them. Who needs to start buying MBS for spreads to tighten significantly?
That's the million-dollar question for the space. Banks are a big piece. They'll likely come back more seriously when the Fed actually starts cutting rates, not just talking about it.
Okay, so banks are waiting for cuts. What about money managers?
Generally, they're already overweight mortgages because they've looked so cheap compared to corporates. There were some outflows early in the quarter, people chasing stocks probably, but they came back to buying later on.
And other mortgage REITs, like Dynex.
They position themselves as a growing source of demand. Dynex even called themselves the manager of choice for agency mortgages. Bold statement.
Okay. Any surprises?
One interesting point was overseas demand. Japan was apparently a buyer in May, which they called a surprise to the upside.
So putting it all together, what's the technical picture for spreads right now?
Net supply of new agency RMBS is still pretty low. But that big wave of demand hasn't fully shown up yet, so it's kind of a medium-term headwind for spreads getting tighter.
Which paradoxically is good for Dynex right now.
Exactly. It lets them keep earning that historically wide spread for longer.
Got it. Let's talk swap spreads. They mentioned the 7-year point being significantly negative to treasuries. How does that play into things?
Right, about 47 basis points below treasuries currently. That negative spread actually creates positive carry for them when they hedge.
Positive carry from a negative spread. Explain that one.
Okay, so when they use swaps to hedge their mortgage assets, the difference between the mortgage yield and the swap rate they pay is part of their profit. Even if the swap rate is below the treasury rate, negative spread, if it's sufficiently below the high yield they're earning on the mortgage asset, the net difference, the carry, is positive and profitable.
Ah, okay. So the absolute level versus treasuries isn't the whole story. It's the level versus the asset they're hedging.
Precisely. And that current negative spread builds in a big cushion. They said it could go to minus 50, even minus 55 on a mark-to-market basis, and the positive carry would still likely keep the position profitable overall.
Provides a margin of safety. What if the Fed doesn't cut as much as the market expects? Say, less than 50 basis points this year.
Well, in that scenario, mortgage supply would likely stay low. So probably not much impact on spreads. Investors like Dynex would just keep earning that attractive spread income for longer.
What's the house view at Dynex on cuts?
Their team thinks 50 basis points of cuts this year is likely. But they see risks maybe leaning towards more cuts later in the year, especially if consumer spending slows down.
Okay, one last technical point. Coupon allocation. They talked about preferring pools over TBAs.
Yeah, that's about how they hold their mortgage exposure. TBAs are to be announced forward contracts, while pools are the actual specific mortgage bonds.
Right.
Lately, the implied financing cost in rolling those TBA contracts has been higher than the cost of financing actual pools in the repo market.
So it's just cheaper to own the pools directly right now.
Basically, yes. So they're strategically moving towards holding more pools. Plus, owning pools gives them more direct control to manage prepayment risk if rates rally and people refinance faster.
And how are they hedging all this? What's the overall duration profile?
They're focusing hedges mainly on the longer part of the curve, think 7-year and 20-year points. About 2/3 of their hedges are interest rate swaps. The goal is to keep the overall book duration pretty flat, pretty neutral to interest rate moves.
So adding yield at the front, hedging further out, seems logical.
It's about creating a stable, hedged return stream.
All right, this is TalkTickers, and you know what time it is, our not financial advice segment. We brainstorm an outrageous but plausible trade idea inspired by today's call. Remember, folks, pure speculation, entertainment only. Do your own homework.
Okay, let's riff on Dynex's strategy. How about this? Go long, specific, lower coupon agency CMBS tranches. We're leveraging that stability story, the prepayment protection, and that attractive yield spread they highlighted.
Okay, long, low coupon agency CMBS. What's the other side? Or the twist?
Pair it with a short position in the belly of the Treasury curve, maybe 7 to 10-year Treasury futures.
Short the belly? Why?
The thesis is a yield curve steepener. You're betting that the market eventually prices in more Fed rate cuts than currently expected, causing shorter rates to fall relative to longer rates. Or maybe longer rates rise less than the belly. Either way, the curve steepens.
So you profit from the CMBS carry and potentially from the curve steepening via the short Treasury position.
That's the idea. It relies on that agency spread dislocation persisting, like Dynex believes, and getting the direction of monetary policy somewhat right specifically, that it becomes even looser than priced. You get carry from the CMBS, potential capital appreciation as spreads tighten, and gains from the short Treasury hedge if the curve steepens as you expect.
That's definitely got a few moving parts, captures the Dynex confidence in spreads, and adds a macro view on rates. But seriously, just an idea, not advice.
Absolutely not advice, just connecting some dots. So to wrap up on Dynex's Q2, strong results, really smart strategic deployment in a tough market, and they're clearly building their operational strength for the long haul.
Yeah, seems like they navigated the volatility very effectively, delivering on shareholder value and dividends. A solid quarter by their account.
Definitely a performance worth digging into.
That's all the time we have for this deep dive. Hopefully his breakdown of the Dynex Capital call gave you some useful insights. Let us know your thoughts. Thanks for tuning in to TalkTickers.